Let's talk about options. And I want to talk about cheap options. I want to talk about expensive options. I want to talk about the way everybody else looks at it. And I want to talk about the way that we look at it. Okay. It's a lot to digest in just a few minutes, but here we go. So, options. And when you're looking at options on stocks, for instance, sometimes you're looking at options that are, let's say, on Chipotle. Chipotle is not a cheap stock. And you look at the near money option strikes, calls and puts, they can be super expensive. Well, they're going to be if the stock's trading at $3,000 a share, right? Maybe we look at something like NVIDIA, which last month, we were looking at something that was around $1,200 a share, and this month now it's with the splits 120. And some people might think, wow, you know what? The options are a lot cheaper on NVIDIA now than they were before split. Well, of course they're going to be cheaper because the stock is 1/10 the price. But I'm going to tell you, that is a very novice way to look at option prices, simply based on the price that you think they are in terms of dollar. I want to take you to a little bit deeper into a level of what's cheap and what's expensive. Now, when folks get out of option traders get out of how much I'm physically paying for an option, then they may graduate to looking at what we're seeing at here. This is the VIX. All right, the VIX is a market volatility index, and the VIX is typically what we hear about on mainstream media. And those of you that are more seasoned option traders might look at the VIX as one way to gauge whether options are cheap or expensive. This is the angst of the market. So when this thing's moving higher, right, typically the overall market's moving lower. Now, what is the VIX? The VIX is a market volatility index of the overall market, typically the S&P 500 options. And when you see it going up, it means option traders are getting more nervous, and the premiums on options are getting higher. When this thing goes down, it means that typically option traders are getting much less nervous. They're getting calm. Typically, the overall market's moving higher, and we're able to gauge where it is on the high side, where it is on the low side, and where it is right now. And that's the first step in starting to understand how options are cheap or expensive, not based on the physical price, but based on where the time premium of an option is and where it's been. We're able to actually gauge that. Now, if you take a look at this right now, this is the VIX as of earlier today, trading around 1266. That's pretty cheap compared to where it was. You go back, now this is a weekly chart going back a year. So if you look at, it's 2 years. You take a look at where it was back in April, and you can see April, it was at 21. And all of a sudden now, as we're in the middle of June, it's 12.66. It's almost half price. In fact, it is half price from where it was back in October and November. Remember, in October and November, we had that big pullback in the markets. Pullback came in, and option traders got nervous, and option prices started getting bid up quite a bit. So we're able to gauge based on the last couple of years where it's been expensive wise, where it is cheap. And right now it's looking pretty cheap. But if you really want to know how we do it, we don't look at the overall market per se. What we do is a start. But then what we do is we go in and we look at individual option prices on individual stocks. So this is an example of the calls on Oracle. And as you can see, we can look at the option symbol. By the way, this is a snapshot when Oracle was trading at 139.27. So the 140 calls are the at the monies, right? You can see here, there's that bid and offer in the mid price. And take a look at this. This is the implied volatility stamp. Now, implied volatility is based off of a lot of factors, right? But it's based off of what? Option Greeks. You're looking at that strike price. You're looking at the expiration date. In this case, we're looking at July 19s. You're looking at where the stock it is, where the strike is, that expiration, interest rates are equated in there, volatility is equated in, and we get that IV, that number. That is a percentage number, right? So we don't look at just one option. We look at the near money, the one slightly above, the one slightly below on both calls and puts. What we do is we timestamp that number, and we can actually build a chart from the average of all these numbers each and every day. It would look like this. This is an example of Oracle. So we took the at the money, those near money calls and puts, and put those together. And here's the timestamp just around 20. And then, of course, here's where it was last week. It was up here near 45. Well, that's because Oracle's earnings were coming in. And when Oracle's earnings came in, they beat expectations. The stock price jumped. And what happened to the implied volatility? Boom, because the unknown became known. But if you take a look, we can actually look out several months, even a year. So we see where Oracle's expensive option premiums are. They're up out here above 50, at least in the last 6 months. And look at the last 6 months of where it's been cheap, down here around 20, right? Let me show you another one. This is an ETF. This is USO. And so USO is the United States Oil ETF, and we can see where the price of USO has been in the last several months, from 70 up here to around 83, back down into around 70, up to around 76.99 today. And then the black line you see here, well, this is the options implied volatility on all those near money calls and puts, stamped each and every day. And we can get an idea of where they were when they were cheap, down here in the low 20s, where they were when they were expensive, up here in the low 30s, and where they are now, low 20s. So this tells me that USO has some cheap option premium. What we're able to do is we're able to look at one of a half a dozen different groupings of options IV. We can look at what has the highest volume, highest open interest, unusual calls, unusual puts, cheap and expensive implied volatility. And we're looking at cheap implied volatility right now. So that's a ranking of IV, like I said, set against near money stock and ETF options over the last year. Where we come up with cheap and expensive, we take that range and we see where are we today. We look at all the optionable stocks, we rank them, but what are the cheapest and what are the most expensive based on their ranges and where they are. So top 10 coming into this week. And this is based on, again, where they've been for their high. Here's their high implied volatility for the year. Here's their lowest implied volatility for the year in this column. And here's where they currently are sitting right now. Now, notice that in every case here, with KWeb, 2673 is the low, 2673 is the last. It means it's sitting on as cheap as it's been in the last year. There's Oracle. I highlighted that because that was a chart that I just showed you. Baidu, IoT, SE, Zoom, SIG, MCHI, YINN, and USO round out the top 10 most cheapest of options right now. Now, the other reason I mentioned these two, not only did I show you them in charts, all of these have cheap implied volatility, but when I started looking at options, both Oracle and USO, when you look at the individual options going out 30 to 60 days, I found that these had the lowest percent to doubles. What I mean by that is that you needed the least amount of movement from Oracle and the least amount of movement from USO if you bought call options for them to double in value, or if you bought put options and they were to double in value. This isn't a recommendation. I'm just telling you, if you're bullish on Oracle or you're bullish on USO, right now the call options are as cheap as they've been, and you need the least amount of movement for them to double in value. And likewise, if you're bearish on Oracle, or you think oil is done and it's going to go lower, and you're bearish on USO, the put options on both Oracle and USO are as cheap as they've been. So again, what can we do with this information? We can take this list of stocks and ETFs, and then, being that they're cheap options, if they come up on a bullish scan for you or they come up on a bearish scan for you, now you automatically know I need to be looking at buying calls, or I need to be looking at buying puts.